Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. market update. As you can see from the background, I'm back up in the mountain cabin where it's supposed to snow tonight. Yikes. Inflation data was released this week for the month of February, which showed an increase of 7.9%. You might be thinking, yeah, we all know that inflation's bad, and you've told us that in the last several recordings. So why do I bring it up again? Well, in the last recording, the inflationary data, the Fed's favorite, showed that was worse since 1984. Now we're down to 1982. So if it gets much worse, we're back into the 70s, which was a period of really high interest rates and stagflation. So that's a word that's being tossed around. Hopefully we don't ever get to that point. Oil cooled off a bit from its big record run, and interest rates have actually gone back up. Does that mean money's coming out of the bond market and ready to go back into the equities market? Let's take a look at the charts. At the time of this recording, it is late on Friday evening, so the futures market is closed. Taking a look at the S&P, you can see that we've moved down here, and look how we're starting to try to find a little bit of support here in the 420 area. If that number is familiar to you, 420 was an area of resistance. We actually had a fib target, Elliott Wave target on the way up at 420. So that was a resistance point, so it makes sense that on the way back down, we're finding some support in that area. But let's not forget that we still have that zigzag in place, which shows a C wave extension down to 400. Now, with the market consolidating here around 420, is it possible that we could get a bounce to the upside from here? Yeah, it is. You can see that we're really in tune with the 10-day moving average, so not oversold or overbought at this point in time. And you have to certainly pay attention to the number of times we've come down and tested 420. Could we bounce and break off that level and start a new bull run? We could. That's a possibility. But also, a scenario that I shared in our insiders meeting last night, which is a meeting we do every Thursday night for our alert subscribers, is here's what I've seen occur before in a scenario that's very similar to this, where you build this support and money maybe coming out of the bond market goes back into the equities market. It looks like we've reached a bottom. We start to move back to the upside. Everybody starts talking about, okay, that was it. We came down to 420. We tested it. We consolidated there, and we've moved back to the upside. And then you get a flush out to the downside where you break that level that everybody thought was support and had held. You get a big spike out of the VIX, and that's when everybody just throws in their towels that are the longs and just say, that's it, I've had enough, I can't take it anymore, and they get out. And that's the kind of panic selling that you get when you reach a bottom, just that cathartic, that's it. So could that happen? I could see that scenario where potentially we bounce from here and then have that big move down to 400. We also see a scenario where we bounce from here. The market's going to tell us where we're going to go, but as I've mentioned in the past, I have a lot of respect for this zigzag. When you have a 61.8% B wave correction, that's my favorite zigzag setup. So we're down to the 61.8% level. From that level, we bounced back up to the previous level. That's classic zigzag Elliott wave pattern formation. You come down, then you retest the previous fib level, and then you extend down to the next one. So either scenario makes sense right now. So this is the point where you rely on the charts. Let the charts tell you what's going to happen. Taking a look at interest rates, as I said in the intro, interest rates is starting to move back to the upside, and that followed with that big rally day that we had. You can see over here, and it looked like it was a massive rally day, but it really wasn't as big as it kind of might have seemed to the upside there on the 9th. Really only got back up to the 10-day moving average, and with what seemed like a monster rally that was occurring, but money did come out of the bond market. We were talking about why we were pulling down in interest rates in the last recording. Why did rates go down? And that was because I think money was moving into the bond market as a safe haven for everything that was going on around the world, Russia, Ukraine, all those stories. And the fact that all of a sudden we started this rally, perhaps money moved back out of the bond market, allowing rates to go back up. We know they're going to go up. We know the Federal Reserve is going to raise rates. They're absolutely determined to win that inflationary game, if you will. They told us so often it was transitory. We know it's not now, and they're just going to do everything they can to pop the inflation bubble, and I think that means they're going to go too far, and we're going to head toward a recession. We'll see if we get to the point of stagflation. So far, growth's been okay. Another interesting thing that came out with that comment or the report on inflation was the fact that wages went down. Now, in the last recording, I talked about how wages had stayed flat, and that was good because wage inflation was adding into the overall inflationary picture. But wages going down, that's not what we want. But we don't want to see that to the point where the consumer feels like they can't spend. The consumer drives our economy. We all know that, and that's how we're working at a 130% debt to GDP. It's because the consumer just continues to spend. If they feel like they don't have the funds to spend, now you really have an economic problem. Looking at the dollar, I wanted to show you that. The dollar had moved to the upside and bounced back up. And then watch what happens today. So we're right smack in this wave 5 here. Now that's up to yesterday. But then when we add in today, boom, we relabeled. So we've relabeled from a wave 5 to a 3. Two reasons. One, we hit the wave 5 target smack on, and it looks like there's still pressure for it to go higher. So what does it mean when a 5 relabels to a 3? It means you're going to get a higher high in the wave 3. So a higher high, that's before we start the wave 4 correction. So more highs to come in the dollar, which I think is a good thing. I've said that I thought the dollar would go to 100. Looks like we're going to go further than that based on the relabeling of the chart today. So I thought that might be something interesting for you. Looking at some of the other markets, looking at the Dow, you can see here with its zigzag pattern, how the Dow is continuing. And it's actually even closer to satisfying its target than the S&P is. So you can see we came all the way down and almost hit that target back on the 24th of February, and it's hanging around the 61.8% extension as well, but it got within a whisper of that 100% extension. And some people say, well, that's close enough. I mean, the zigzag was satisfied, but as I tell our subscribers, often that line gets hit. I mean, it really gets hit the majority of the time. It's not that it just gets close. So I really don't think that the downside may be over yet on the Dow, other than the scenario of the bounce that I was talking about. So looking at the Qs, same thing here. You guys have asked about looking at these markets. I really struggle with what's going to happen with the Qs this year. With interest rates going up, I think it's going to be a long year for those, and you can see the really nicely formed 5-wave impulse pattern to the downside with a great wave 4 at the 38.2% fib level. So I think we're looking at 300 on the Qs at some point, and that's whether or not the rest of the market bounces or not. I just don't see how the Qs are going to have much of a chance with the rate that the Federal Reserve is going to be raising rates. It's just going to be a difficult time for anything tech related. Looking at the IWM, one of our subscribers pointed out last night, hey, is there a little triangle here? And you can see this trading range clearly that the IWM is in, and we were talking about having a chat because we do live Q&A with our subscribers. Are we going to have a scenario here where all of a sudden, where 2021, the range was between 210 and 230, are we just dropping the range down 20 points and we're going to go down where we're looking at a range between 210 and 190? It's a very distinct possibility with the way we've started off 2022. Now, we do have this triangle. It tried to break out both ways today and couldn't on either direction, so it's just kind of right there at the point. Last time we had triangles in that other trading range, it would break up to 230 and break down to 210, but wouldn't make a significant run. We'll see if that changes with this new lower range, but pretty interesting that the IWM is right back to its old tricks. Looking at oil, you guys asked about oil, and we had a nice oil trade. I told our viewers on TradeFinder on Tuesday night. By the way, if you haven't signed up for TradeFinder yet, you can do so. A link underneath the video, or go to our website, ewotrader.com, and sign up for TradeFinder. We do live webinars every Tuesday night. It's free. We talk about the markets, we look for trade ideas, and we have a live Q&A there as well. So it's a lot of fun. Love to have you if you haven't attended one before. And so Tuesday night I shared that we had sent out an alert, a put alert on oil. Believe it or not, with oil going up as fast as it's been, we actually bought puts, and that was because we were just so overbought at that point in time. And if we walk the chart back, you can see that right there, we are significantly away from the 10-day moving average, and we've gone vertical. And if you've heard any of my recordings, you've heard me say both of these things. No security in any time frame gets very far away from the 10-day moving average, and what goes straight up often comes straight back down. So we sent out a put, we did on the recording, look at the TradeFinder recording, and boom, very next day, there we go. Big move to the downside. So that worked out fantastically well. It's great to get in and out in a day on a trade where you generate a nice return. And that's just because of those scenarios. It's in a wave 3 to the upside, but you still have to keep in mind when things go too vertically, when they get too far away from the 10-day moving average, when they get into overbought and oversold conditions, that's going to rectify. It either goes sideways or it retraces. And the more vertical the move, the more likely it is that it retraces to satisfy that gap between the 10-day moving average to correct that back down versus just moving sideways and allowing the 10-day moving average to catch up. Quick look at natural gas, and you can see that it's nothing like the chart of oil. Hasn't had the same move to the upside. Kind of thought that it might play tag along with oil with the same scenario that's going on over between Russia and Ukraine, but it hasn't. We did have a UNG trade back here, but now what looks interesting is potentially putting on a strangle, because that is a well-formed triangle. And as you can see, I put the Elliott wave on, but there's not a impulse pattern labeled. There's not a 5-wave impulse pattern labeled. So if it's not labeled there, it means it's in a corrective phase, and that's what a triangle is. It's one of the Elliott wave corrective patterns. So that looks like that could be interesting, and our subscribers may see that at the beginning of the week, a strangle on UNG, because that's just a well-formed triangle there. And boy, you want to talk about another chart that went vertically up? Holy wheat, Batman. Look at that chart. And what happened? Right back down. Same scenario. When you go vertically up, often you come vertically back down. And we were talking about that during TradeFinder as well, and talking about ways that you could have traded wheat. WEAT is an ETF that you could have potentially used. That move is pretty much over now as far as the correction of the overbought scenario, but just giving you an idea of the things that we chat about in TradeFinder. So again, sign up if you haven't already. Looking at the metals, and I wanted to talk to you about gold because you can see that gold had this big move to the upside and pulled back down a little bit. But what I really wanted to share, and then there's the Elliott wave telling you that it's in a wave 3, so strongest impulse pattern. Are we correcting in the wave 4 now, or are we just now moving a little bit of a rectification of the overbought scenario with gold as well? And so we'll see if that wave 4 gets labeled or if we have a new high in the wave 3. But it looks like gold wants to continue. And when we look at this chart on the weekly chart, GLD, on the weekly chart, you can see that there's a massive symmetrical triangle there. And it goes back to early 2020. And then this breakout has occurred already. So if you utilize the rules, and we have all this education on our website at ewotrader.com, we talk about how to forecast about where the move is going to go, and then give some ideas on where's the best IV move to take profits on a breakout of a triangle pattern using our unique strangles, is the fact that the target price here is around 210. So we go through and we talk about how to calculate where the targets are going to be, taking 80% of the mouth of the triangle from the high to the low, from the bar of the lower highs and the bar of the higher lows, from the entry point in the triangle. Subtract those, take 80%, and that gives you the target. So it looks like gold wants to continue higher. Now remember, this is a weekly chart, so it doesn't mean it's going to continue to go vertically up like that. In fact, I hope it really doesn't do that, but something to think about for the long term. Now, putting on a strangle wouldn't make a lot of sense because too much time value included in that. But now that we've already had a confirmed breakout, you could take a look at doing something, maybe leaps a longer term bullish trade along those lines. And you can see there's a little separation with the 10-day moving average, so maybe gold needs to rest a little bit. Note that to end the week on this weekly bar, we closed near the low of that bar, again showing you that we were getting too far away from the 10-day moving average, so gold was getting overbought as well. And then silver, we had already closed out our gold trade right before the war started, so we missed that big bar, but we still had a really nicely profitable trade. We still had silver, and we nailed silver's exit. We exited here on the 8th, so that one worked out extremely well. And that one was a strangle that we had where we could have gone either way, and it generated over 106% return out of a strangle. That's a good return on a strangle, where they're usually 30 to 70% in that area. So if we put the Elliott wave pattern on here, just like gold, we're in a wave 3 to the upside here. It hasn't quite spiked as much as gold did, but pretty close, and is consolidating really nicely here. So same scenario here with silver. It doesn't look like silver's done either, but you want to take advantage of that IV spike when you have a big move up like that. Plus you're getting overbought. It's a good time to take your profits and watch and see if you get another entry. Bitcoin, you can see that Bitcoin really flirted with going up to that 44,000. We talked about this triangle formation last night as well. You could kind of make a case for a little bit of a symmetrical triangle forming, or you could look at it this way and say, well, you know, that 36,000 level that we've talked about so often is support. So is it a descending triangle? Is it a symmetrical triangle? I think you can make a case for either way, but the bottom line is it's consolidating, and that means that something's likely getting ready to happen. Now, you can see it's in a 5-wave impulse pattern to the downside with another one of those wave 4s at the 38.2% fib level. It's a pretty good fib level, and it tested it here on this move right when the war started, and then we've started to head back down. Are we going to break 36,000 this time and go down to that wave 5 target? It's going to be interesting to see. Now, Elliott would say that when you have a triangle in an impulse pattern like this, the triangle is likely to break out in the direction of the impulse. So he would say lean towards the downside. My experience over the years has been, don't pick a direction. When you have a triangle, respect the fact that it can go either way, and let that be the lead, even superseding anything else. That's just been my experience. So by looking at Bitcoin here, it's going to be interesting to see which direction it breaks out. However, all right, closing with the VIX as we always do, you can see that we have come back down, but still above 30. Amazing the amount of time that we've stayed above 30, and not much of a bounce up today, considering the fact that we did kind of sell off towards the close, but staying above that 30 level. Volatility remains. For how long can we stay above 30? I've been surprised that we've stayed above 30 this long, but I think volatility is here to stay. I don't know if it's going to be this high unless we get that washout scenario that I pointed out. So let's see if that occurs. Hope you have a wonderful weekend. Look forward to talking to you again next week. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.